Do you ever feel like no matter how hard you try, your finances are just out of control? You're not alone. Many people make simple mistakes in personal finance that can end up costing them a lot in the long run. If you're ready to learn how to avoid the biggest financial blunders and take control of your money, then this video is for you. Stick around as we explore the top mistakes to avoid in personal finance and give you actionable tips to help you build a solid foundation for your financial future. Personal finance is one of those things that seems easy when you first start out, but over time it can get complicated. Whether you're managing debt, saving for retirement, or simply trying to make sure your bills get paid on time, there's a lot to consider. The issue is that people often make small financial mistakes that snowball into major problems down the road. But here's the good news. These mistakes can be avoided. The first step is understanding what they are and how they impact your financial well-being. In today's video, we'll take a deep dive into some of the most common and costly mistakes that people make in their personal finances, and I'll give you the tools and strategies to avoid them. By the end of this video, you'll be ready to start making smarter, more intentional choices with your money. 1. Not tracking your spending. One of the most insidious mistakes you can make in your financial life is failing to track your spending. It's easy to think that you have a pretty good idea of where your money is going each month, but in reality, most people underestimate their daily expenses. Small purchases like your daily coffee, lunch, or impulse buys can add up quickly, and before you know it, you're living paycheck to paycheck without understanding where your money went. Why it's a mistake? Without tracking your spending, it's almost impossible to know if you're overspending, undersaving, or missing opportunities to cut back. Untracked spending often leads to debt accumulation and difficulty sticking to a budget. Many people also find that they forget about recurring expenses like subscriptions, memberships, and automatic renewals, which can significantly drain your account without you even realizing it. How to fix it? Start by tracking every penny you spend. You can use a variety of methods to track your spending, from manual record keeping in a notebook to using modern budgeting apps like Mint, YNAB, You Need a Budget, or Pocket Guard. These apps will automatically categorize your transactions and show you where your money is going, helping you identify areas where you can cut back or redirect funds toward your goals. By tracking your spending, you gain control over your finances and can make more conscious decisions about where to allocate your money. 2. Ignoring the importance of an emergency fund. It's easy to think that emergencies are something that happens to other people, but the truth is, life is full of unexpected surprises. Whether it's a sudden medical expense, a car breakdown, or a job loss, emergencies always seem to hit when you're least prepared. Not having an emergency fund can quickly lead to debt or even financial ruin when these situations arise. Why it's a mistake? When you don't have an emergency fund, you're essentially setting yourself up for failure when life throws you a curveball. Emergency expenses often lead to using credit cards or taking out loans, which can have high interest rates and worsen your financial situation. Without a safety net, you'll end up scrambling to find money or going into debt at the worst possible time. How to fix it? Experts recommend building an emergency fund that covers at least 3 to 6 months of living expenses. This fund should be easily accessible, like in a high-yield savings account or a money market account. The key is to make sure that this fund is specifically reserved for emergencies only, and not used for planned expenses like vacations or home renovations. Start small, even if it's just $50 or $100 a month, and build it over time. Having an emergency fund will give you peace of mind and protect you from financial setbacks when the unexpected happens. 3. Living beyond your means. Another common financial mistake is living beyond your means. This typically happens when people spend more money than they earn, often by relying on credit cards or loans to cover the gap. It's easy to get caught up in the keeping up with the Joneses mentality, where you feel the pressure to spend on things you can't afford, whether it's a new car, designer clothes, or the latest tech gadgets. Why it's a mistake? When you live beyond your means, you're accumulating debt and setting yourself up for long-term financial struggle. The issue is compounded by high interest rates on credit cards, payday loans, and other forms of credit. This debt then becomes harder to pay off as interest accrues, leading to even more financial pressure. Over time, living beyond your means can result in financial instability and even bankruptcy. How to fix it? The first step to avoiding this mistake is understanding your income and setting a realistic budget. Start by evaluating your monthly income and expenses, and then determine a reasonable amount that you can spend on discretionary items without exceeding your means. Avoid taking on new debt unless absolutely necessary, and focus on paying off high-interest loans first. Living within your means doesn't mean you have to give up everything, but it does mean making thoughtful, intentional decisions about what you really need versus what you just want. 4. Not saving for retirement. Many people put off saving for retirement, thinking that they have plenty of time to start later. However, the earlier you start saving, the more you can take advantage of compound interest and the less you'll have to save each month to reach your goals. The mistake of waiting until later in life to start saving for retirement can leave you with a significant shortfall when you're older. Why it's a mistake? Procrastinating on retirement savings means you miss out on decades of potential growth. Without a dedicated retirement plan, you could find yourself working far longer than you anticipated or relying on minimal Social Security benefits to get by. The longer you wait, the harder it will be to catch up and achieve your retirement goals. How to fix it? The key is to start saving as early as possible, even if it's just a small amount at first. If your employer offers a 401k plan with matching contributions, take full advantage of it. If you're self-employed or your employer doesn't offer a retirement plan, consider setting up an IRA, individual retirement account, make regular contributions, and if possible, increase the amount as your income grows. Even if retirement seems far off, every dollar you invest now will compound over time, giving you a much larger nest egg when the time comes. 5. Relying too heavily on credit cards. Credit cards can be a great financial tool when used responsibly, but they can quickly become a burden when misused. Many people rely on credit cards to pay for things they can't afford or carry a balance from month to month, leading to high interest charges and mounting debt. Why it's a mistake? Credit card debt can quickly snowball due to high interest rates, and if you only make minimum payments, it could take decades to pay off your balance. Additionally, missed payments can negatively impact your credit score, making it harder to get loans or secure favorable interest rates in the future. How to fix it? If you use credit cards, make sure to pay off your balance in full each month to avoid interest charges. Create a budget that accounts for your credit card spending and make it a priority to only charge what you can afford to pay off in the same billing cycle. If you're already in credit card debt, focus on paying off high-interest cards first and avoid adding new debt to the pile. Over time, you'll reduce your reliance on credit cards and improve your financial situation. 6. Failing to diversify investments. One of the most common mistakes investors make is not diversifying their investment portfolio. Many people tend to invest in a single stock, asset, or industry they're passionate about, believing that focusing on one area will yield the highest returns. While it's tempting to bet on what you know, it's a risky strategy that can leave you exposed to a significant loss if that particular asset takes a downturn. Why it's a mistake? When you concentrate all your investments in one stock or sector, you're gambling with the success of that investment. A single market downturn or company failure can wipe out your entire portfolio. Without diversification, you're not spreading risk across different assets, which is one of the key principles of sound investing. How to fix it? Diversification is about spreading your investments across different asset classes, such as stocks, bonds, real estate, and even alternative investments like cryptocurrency or commodities. In addition, consider investing in exchange-traded funds, ETFs, or mutual funds that automatically diversify your portfolio for you. A well-diversified portfolio can help cushion the impact of market fluctuations and reduce the overall risk of your investments. By holding a variety of investments, you can weather the ups and downs of the market and ensure that one bad investment doesn't jeopardize your financial future. 7. Not having a clear financial goal. Another common mistake is not setting clear, measurable financial goals. Whether you're trying to pay off debt, buy a house, save for retirement, or build wealth, not having a defined goal makes it harder to track progress and stay motivated. People often get caught up in the day-to-day grind of managing their money without taking the time to think about where they want to be in the future. Why it's a mistake? Without clear financial goals, it's easy to lose focus and get distracted by short-term wants. Without a roadmap, it's hard to make decisions that align with your long-term financial objectives. Whether it's retirement, buying a home, or becoming debt-free, vague goals lead to vague results. How to fix it? The key to effective financial planning is to set specific, measurable, attainable, relevant, and time-bound, SMART goals. Start by identifying what you want to achieve with your money in both the short and long term. Break your larger goals into smaller, actionable steps and create a plan to track your progress. For example, instead of saying, "I want to save more money," say, "I will save $500 each month to build my emergency fund within the next 6 months." Having specific goals will give you direction, keep you motivated, and help you make better financial decisions. 8. Overlooking taxes. Taxes are an inevitable part of life, yet many people fail to take them into account when making financial decisions. Whether it's investments, retirement savings, or income, understanding how taxes affect your finances can save you a significant amount of money over time. Why it's a mistake. By not accounting for taxes, you could be missing opportunities to reduce your tax liability, which could leave you with less money in your pocket. Many people don't consider the tax implications of selling investments, contributing to retirement accounts, or earning additional income. Ignoring taxes can lead to surprises when it comes time to file, which could result in penalties or underpayment. How to fix it. It's crucial to learn about the tax implications of different financial moves. For instance, contributing to tax-deferred retirement accounts like a 401k or traditional IRA can lower your taxable income today, while Roth accounts allow you to withdraw funds tax-free in the future. Understand capital gains taxes when selling investments and how to take advantage of tax-efficient investment strategies like index funds. If you're not sure how taxes affect your financial situation, consider working with a financial advisor or tax professional to help minimize your tax liability. Avoiding these common financial mistakes isn't about being perfect. It's about making small, consistent improvements over time. By tracking your spending, building an emergency fund, living within your means, saving for retirement, and using credit cards responsibly, you'll be setting yourself up for financial success. The most important thing is to take action today. Start small, stay consistent, and you'll soon see the positive impact on your financial health. Remember, personal finance is a journey, and you're on the right path just by educating yourself and taking control of your money. Thanks for watching, and be sure to hit that subscribe button for more financial tips and strategies. Don't forget to tap the link below to get started on the easiest way to make money online. See you in the next video.